97% of money in the United States doesn't physically exist. It's not printed by the government. It's not sitting in bank vaults. It's credit. Numbers created when banks lend money. And this invisible force, it's what drives the economy. It pushes markets to soaring heights and eventually drags them down into painful crashes. So if you don't understand credit, you don't understand how money actually works or why markets behave the way they do. In this video, I will show you what credit really is, how banks create money out of nothing, why credit creates both highs and lows in the stock market, and how you can use this knowledge to make smarter investment decisions. So before we understand what credit is, we need to understand something more fundamental: productivity. So what is productivity? Productivity is the total value of goods and services produced by a country. The official term for this is GDP, gross domestic product, and if we measure it per person, then it becomes GDP per capita. Now if you look at the data for US GDP per capita adjusted for inflation from 1871, the chart goes up pretty much a straight line. So you can think productivity as long-term economic growth. So what drives the economy? There could be multiple reasons like technology, innovation, education, political stability, culture, and of course hardworking people like you and me. So if productivity goes smoothly over time, you'd think in the long run the stock market should do the same, right? A graph with one straight line up, but that's not what we see. Instead you get crashes, bubbles, recessions multiple times. Why? Because productivity isn't the only factor controlling the economy. Credit is the other. So what is credit? At its core, credit is trust. You get money now with a promise to repay later with something on top called the interest. So basically you are borrowing from your future self. Yeah, because your future self would have to repay the loan. Now you might think, okay, I'm just borrowing from someone else. That's not new money, right? Well, yes, if you are borrowing from your friend, but no, if it's a bank. Because banks play by very different rules. Let's see how banks create money from nothing. Let's say you deposit $1,000 in your savings account. Now you can see $1,000 as your bank balance in the bank's online app. But the bank doesn't just lock your money away in a vault. Under something called as the fractional reserve system, they are only required to keep a small portion, let's say 10%. So the banks keep $100 in reserve and lends the remaining $900 to someone else, maybe someone buying a car. Now here is where it gets interesting. The car seller, let's say a dealership, deposits that same $900 into their own savings account. Now just like before, the banks keep 10%, which is $90, and lends out the remaining $810. Now watch what's happening. Your $1,000 is still sitting safely in your account, but now the borrower has $900, the dealership has $900, and the next borrower has $810. That single deposit is now multiplying, not just once but again and again. After a few rounds of this, your original $1,000 has magically become $10,000 circulating in the system. This is how banks create money when they lend. As long as everyone doesn't withdraw at once, the system works just fine. But when everyone wants their money back at the same time, maybe during a panic or a crisis, the bank can't deliver. Because remember, most of the money was never actually there in the first place. It was loaned out. This situation is called bank run, and it's not just theoretical. That's exactly what happened to Silicon Valley Bank in 2023. A sudden loss of confidence triggered mass withdrawals, and the banks simply couldn't keep up. Here's the shocking part. Right now, the Federal Reserve requires banks to keep 0% as reserve. Yes, 0. That means they are not legally required to hold on to any portion of your deposit. So in theory, your $1,000 could multiply endlessly across the system. But in practice, two things keep that from spiraling out of control. Number one, someone has to borrow that money. Banks can only create new money when someone is willing to take a loan. And when that demand to take loan slows down, the machine starts to break. That's what happened before the 2008 crash. Banks ran out of qualified borrowers, so they started offering ninja loans. No income, no jobs, no asset. These types of loans were very risky, but it worked until people started defaulting and the whole system came crashing down. Number two, the Fed still watches. Even with 0% reserve requirement, banks aren't completely unsupervised. The Federal Reserve keeps a close eye onto these banks and how much leverage they are using. If it starts to look dangerous, then the Fed steps in and tells these banks to raise capital requirements, tighten lending, or impose some limits. So yes, banks can create money, but it's not a free for all. But if credit causes economic collapse, then why do we have this system? Because without credit, most people couldn't buy homes, cars, or even go to college. Businesses couldn't invest or expand. Governments could not fund programs. Credit drives spending. Spending drives growth. And during recessions, central bank actually encourages more credit to stimulate demand. Now, as we have understood how banks create money, let's understand the leverage cycle. Let's break it into two phases. Phase 1, expansion. When credit is flowing, everyone feels rich. Jobs are up, consumption is high, vacations, cars, new homes, life is pretty good. But we are consuming more than we are producing. Over time, this creates inflation. Prices rise because too much money is chasing too few goods. So enter the Federal Reserve. They basically have two jobs. Number 1, keep inflation low. And number 2, keep employment high. So when inflation rises fast, the Fed raises interest rate. Higher the interest rates, borrowing gets more expensive. So less people borrow now. So credit slows down. So phase 2, contraction. Now the party ends. People cut back, businesses slow down, layoffs happen. This is the recession phase, the painful part of the cycle. It's the time to pay back the loan. So people consume less than they produce. And add psychology to the equation, greed or FOMO at the top and fear at the bottom. You get the full picture. That's what causes market highs and lows. If you are an investor or just someone trying to make money in the markets, there are few credit related signals that you should definitely watch. First up, the job report. Every month, the Bureau of Labor Statistics drops fresh data and it moves the market. Take a recent example. The job numbers came in weak and boom, the Fed had to cut interest rates. That brings us to the next one, Federal Reserve interest rate decisions. When the Fed adjusts rates, it's basically signaling whether we are heading towards an economic expansion or a slowdown. And then there is debt across consumers, corporations, and governments. Too much of it, it's a red flag. Credit card default rates are another metric. If defaults are rising, it usually means people are under financial stress. And don't forget mortgage data. Housing is super sensitive to credit conditions. When borrowing gets more expensive or people starts defaulting, it's often a warning sign. Because here's the thing, credit usually peaks before a recession. And if you're tracking this stuff, you can actually see it coming. And there is a pro tip on how to avoid bank run risk. If you got a large savings balance, don't just let it sit unprotected. Here is how you can keep your money safe. Make sure your bank is FDIC insured. Keep your deposits within the insured limit per bank, and if your deposit is over the limit of the insured amount, then spread your deposit across different banks to stay fully covered. Now that you understand credit, the invisible engine behind the economy, you should watch this next. 4 real reasons why you should invest. Because knowing how the game works is the first step to playing the game well.